Hey everyone. Before we get into today's show, I want to give a quick shout out to our sponsors, Coinbase Prime and Ledger. Love these companies, genuinely proud to call them sponsors of the show. You're going to be hearing all about them later from me, but now on with the program. All right, everyone, welcome back to another weekly roundup edition of On the Margin. I am joined, as always, by my indubitable co-host, Mr. Mark Yusko. What's going on, Mark?
GM.
GM.
I've actually said that, right? All right, so got to open with the reveal. So, in light of the wild action that we've had, I got the Bitcoin roller coaster socks on today.
Let's go, Mark.
So, and the thing about a roller coaster, Michael, is it starts, goes up and down and up and down and up and down, and it ends in the same place. So we're going to talk about that at some point, that there's this weird vibe to me that feels very 2018, which I don't like, but we'll get to that.
You know what? Again, we're just in sync here because just like we were talking about for 2 seconds before this kicked off, I am in London currently. I've been in Lisbon for the last week. I went to Solana Breakpoint. Got some takeaways before we get into our stories here. First of all, I got to say, the organizers of this event crushed it. And the Solana ecosystem, I kind of went there. I wanted to see how real is this ecosystem? What does the developer community look like? Are people building real projects? I came away very solidly with two takeaways, which was one, this is a real ecosystem. There is a differentiated community here. This is going to survive multiple cycles. And I really think that Solana is here to stay. But I also firmly came away with, we are nearing the top.
Yeah.
We're nearing the top, baby.
Well, look, the fact that I just said GM means, we definitely, because that didn't start with old guys like me. So,
that there's a token called GM that I'm
Michael, I was going down that rabbit hole last night, and there's actually multiple. There's knockoffs. There's GM, GMC. I mean, there's multiple attempts to try to capitalize on this movement.
So just to there were a couple projects. I mean, one of the things that I think is pretty interesting about the Solana ecosystem, it's built on, the developing language. They use something called Rust, right? And there's a very different language than Solidity. Overall, an important thing that I think I missed from the Solana ecosystem is their DeFi thing is based on a central limit order book as opposed to the AMM model that you have in ETH. It's more efficient. It's more, price efficient as well. So you've got a lot of really interesting financial products being built in that ecosystem that wouldn't be as possible in the ETH ecosystem. But I will say what gave me 2017, 2018 vibes is talk to someone building OnlyFans on Solana, talk to someone building Uber on Solana. And, it's not really worth engaging. The third guy I talked to at the conference, I was like, where do you work? He's like, I'm just in dog coins. So,
Absolutely. Look, I mean, the number of people who believe that the meme coin thing is real somehow is pretty alarming. And look, there's no debating the fact that money has flowed into these things, right? And the price has risen, and that makes everybody feel good. But there is this interesting challenge, and we talked a little bit about this last week, is, well, if there's one wallet that controls billions, what happens if they sell? It's like, what happens if Elon Musk sells a bunch of his stock? The price goes down. So it's interesting. And look, I agree with you. If we just focus on the ecosystem, it's amazing. We are big owners of Solana, as we've talked about, and we're happy about it. It's going to be a huge winner in our fund. But I do worry that, as you said, this is one of many, many, many kind of examples of excessive behaviors that usually mean the speculative frenzy is nearing a temporary, because it's only a temporary end. It's why I'm wearing the roller coaster socks, right? It's not that we aren't higher today than we were in 2017 or 2013 or 2009, but there are these cycles, and the down of the roller coaster ride can be super fun or super scary, depending on your tolerance.
I'm with you. And I really don't mean this to come across as a bearish. By the way, I don't think this run is over. I really don't. But what I do think, there were just some signs that were kind of initial worrying signs to me. And two of them, again, that I'll just point out and flag is one, just the speed at which VC deals. My heart went out to you, Mark. As I was listening to these people, it's like you get on a call, seed deals being valued at $40 million. If you don't commit on the phone, you're just not getting in. And it doesn't even matter who you are, right? People aren't returning A16Z's emails. That's the phrase. And someone tweeted a little while ago. Remember when Bitcoin did that sell-off in May, and some FinTwit guy came out and said, "Look, this definitely isn't the bottom or this isn't the top because at the top, no one is worried. No one's asking, is this the top or not?"
Correct.
And I have to say, I went to a bunch of parties and, I was kind of saying, this feels a little bit, excitable. And people were saying, well, don't you believe in the super cycle thesis? And I was like, oh, man.
There you go. No,
yeah,
look, Michael, I was walking around Silicon Valley back in 2000 during the last crazy wave of technology bubbles, and was actually sitting in the lobby of a VC firm and waiting our turn, right, and to beg for capacity, and phone rings and the assistant answers it and says, we don't talk to anybody east of California. So I'm sorry. And hung up. The receptionist was vetting calls based on physical location. And that's just how crazy it was. There was just so much to do. And, I don't know if I told the story to people before, but, I met with this one guy. And I was public, and I actually was in, I don't know, Forbes or Fortune, it doesn't really matter which one, saying that, look, $1 billion for venture capital in 2000, not in crazy devalued money today, but $1 billion for a venture capital fund in 2000 was crazy, and it wasn't going to work. And I had this venture capitalist come to North Carolina. He's like, well, Mark, I'm sick of you talking about, actually didn't call me Mark, he called me Yusko, I'm sick of you talking about, $1 billion is too much. We're not raising $1 billion. I said, Jonathan, 960 million is $1 billion, dude. Come on. And he's like, well, look, I've done the math. And at 800 million, I make more off management fees than carry. And let's face it, this is a game of enriching the general partner, not the limited partner. My partner looks at me and says, did he just say that out loud? I'm like, it's one thing to think it, but geez, really? And so, needless to say, we didn't invest. Now, he tells a different story. I've heard Pete tells me he kicked me out of his fund. I'm like, good. So I'm going to tell a bad story on myself. I might have done a little happy dance, just a little one, when that fund went down 85%. Because I felt badly for the LPs, of which I'm happy not to be one. But I just, the arrogance at these peaks is palpable, right? It's absolutely palpable. And you're right. It's about commanding valuations for nothing. I mean, literally for an idea. It's about not returning phone calls. And so I don't know. We'll see.
It is what it is. And, it's a stressful time, honestly, to have a lot of money or be a market participant because, look, to be totally, to caveat this, I haven't taken any risk off the table. I'm here saying, I think this feels very toppy, but I mean, I think it could do another 4X. I just have no idea. My personal target for this cycle has been a $10 trillion market cap. We're still not there. What I am just saying is you're starting to see early warning signs that tend to accompany these peaks. So I have no special insight. This is just me thinking out loud and giving honest, feedback from
No, like I said, again, back to the socks, right? Is from my friends at Mount Sox, by the way. The reality is this feels a whole lot to me like November 2018. And if you remember that period, we had this kind of floor at $6,500, and we kept trying to bounce over it, and every pump had a dump, dump, and just kept hitting this floor of $6,500. And nobody, and I thought it was nobody, and someone said, no, Travis Kling actually wrote about it and said that this was going to dump one more time. And sure enough, we dumped all the way to 3,200. Now, my favorite part, and I just tweeted this out the other day, hashtag don't get shift. Peter Schiff at 3,800 after the first drop down in November, basically said, okay, I told you this is going to zero. Again, he said that. And literally it was almost at the generational low, which was, December 4th or something at 3,200. But I actually am going to ping Travis later on today and see, because we've had this, on the, futures announcement, pumped to 65 and then dumped. And then we pumped to 68 the other day and then we dumped. And then we pumped to 65 yesterday and dumped. And we've been hitting this flat line around 60,000. And I don't know, there feels like an air gap back to kind of January, February levels, which would be an ugly thing. Now again, I'm not predicting that. I'm not saying that's going to happen. And there are a lot of reasons why it might not, but we are late in the cycle, right? If we are following the 4-year cycle, we are late. And whether we are, 30 or 60 days away from the end, don't know. But, we're past the first cycle, the 17 cycle. We're not past the 13 cycle. That's like 60 days from now. So I don't know. We'll see. But
we'll see. I have no special insight. You've been a market participant for so much longer than I have. I trust your instinct. Look, could be 30 days, could be a year. I have no idea. I guess we'll just have to stay tuned. All right, let's switch it over to some of these charts here. Now we're going to start with a series of charts put together by our mutual friend Lynn Alden, who is just so great.
Love.
She is the best. We actually had her on the podcast this week with Urian Timmer of Fidelity. But looking at a couple of different charts here about inflation. So obviously we got to talk about the 6.2% CPI print that happened in October. The big thing that she's charting here, we're looking at CPI, and we're also matching it up against the 3-month Treasury bill interest rate, which is extremely low. And you can see that there's just a tremendous gap, right, in between what CPI is doing and what interest rates are doing. And she kind of compared it to 2 different periods of time, which is the 1940s and the 1970s. The big difference here is that on the left, you're looking at a chart of the 1940s, for those of you who aren't following with the charts. And you can see the CPI is really spiking, but interest rates are kind of held firm at an extremely low level. This is what we refer to as financial repression, right? So there's a huge gap in between interest rates and what's going on in CPI. Basically, bondholders get annihilated in this instance. Then you're looking at the right, and you're looking at the 1970s, and actually it's very different because what happened is as CPI went up, interest rates followed it. And around 1980, we had Paul Volcker. He famously fought inflation, jacked interest rates up to about 18%. So even though you had inflation in both of those scenarios, very, very different environments. And again, this is closing out Lynn Alden's thoughts here, but this is the Fed fund effective rate compared to CPI, and this is the largest gap that we've had since the 1940s. So I think my takeaway here is that we are nearing extreme territory. Mark, what do you think about when you look at these kind of 3 charts in conjunction with one another?
Yeah, look, I as always, great analysis. And, normally, I have a hashtag for everything, but I have a hashtag for this, alligator jaws always close. So you'd look at this first one and you would say, oh, has to close. But I don't think so. And there's 2 reasons. One, I do think that this CPI blip is simply measuring the devaluation of the currency. I tweeted about this morning. This is not inflation. Right? This is a all-out devaluation, destruction of Western currencies. U.S., Europe, and Japan all simultaneously race to the bottom. And so that's the first thing. Second is what this shows is the death of normal in after the global financial crisis, right? It's over, right? The Fed has lost control. I used to talk about, quote unquote, Fed in a box. And they're in the box, and the box is locked, and they ain't getting out. They are not Houdini. There is 0 chance they can raise rates, 0, right? Because the world can't afford it. People are drowning in debt. Governments are drowning in debt. Individuals drowning in debt. Businesses are drowning in debt. And it was like, oh no, they have all this cash. I'm like, yeah, because they have debt that they issued to buy back stock to enrich the 1%. And so I worry that people are thinking this is an inflationary period like the 70s. And I think what we're going to see is it's really more like a deflationary period of the 30s and 40s. And, we're still in recession, right? The recession has not been called. And what happened in the 1930s was they took interest rates down to zero, this financial repression that you talked about, Michael. And they tried to stimulate the economy with free money. And instead, nobody took the money because there was no demand and there were no jobs. And they basically turned a garden variety recession into the Great Depression. If you go back to the 30s and 40s, it was also, there was a big spike in oil and there was a big spike in food. And those spikes in commodity prices presage these contractions in economic activity. And I think you've talked about Russell Clark's presentation on food inflation that he did 14, 15 months ago, which basically predicted all of this, right? Said all this stuff was going to happen, and now it's been exacerbated by the nat gas problem, which is going to increase fertilizer prices, which is going to decrease the planting of corn, which is going to decrease the feed for hogs, which is going to, and the ripple effect of that is going to be continued pressure on the things that people need to live, and financial assets are going to continue to spike. We're going to continue to get this wealth divide.
Yeah. I have a question for you. Did you see one thing that was really surprising to me that I just didn't understand for the life of me, couldn't get a good explanation for this, was on the day that CPI print, 6.2% in October, became public, the dollar actually spiked, which made no sense to me. I didn't understand what's going on there at all. Do you have any theories on why that might be?
Well, a couple things. So one, the dollar that we always talk about, right, is DXY. And right. DXY is basically 60% euro, 30-something% yen, and then a smattering of other stuff. So it's really just the relative attractiveness of the big three. And I talk about this, if you look over the last 10 years, it was always coordinated around WEF. So all the central banks would gather in Switzerland, and they would decide. I think they probably did, right? Ink a bink a bottle of ink, the cork fell out and you stink. I really think they did that and said, okay, you're in the hot box. Your currency has to appreciate so the rest of us can devalue so that we can save our economies. And I think, if you look, Europe's in the worst shape, right? In terms of economic depression, as somebody said, Europe is becoming a fine open air museum. Just really tough for them to. I don't know if you've driven around, Italy. Like I was with my son a couple of years ago, driving around Italy, and buildings boarded up and no young people. Crazy sad. It was like driving around. I took my mother-in-law back to where she grew up in Kankakee, Illinois, and Hobart, Indiana, a couple weeks ago. So sad. Bombed out buildings, literally things that have burned but didn't burn to the ground and just left for dead, and businesses shuttered and houses for sale and no bids, right? In Chapel Hill, house goes for sale, you got 47 bids. And so I think that's what it is. And that's a long explanation, but the DXY is an imperfect instrument for valuation of the dollar relative, because the currency that's been the strongest over the last 20 months, renminbi. Interesting. Because remember, a strong currency is a sign of a strong economy. So if you compared China, US, Europe, and Japan's been mired in deflationary depression for 30 plus years, not getting out of it anytime soon. Demographics are a problem. Debt, massive problem. So they have no chance to stimulate inflation or economic growth because they just don't have enough people, young people. Europe, right behind them, 9 years behind them demographically, and they're looking uglier and uglier all the time. And now with the lockdown nonsense, and they're shooting themselves, not in the foot, but literally like in the femoral artery, trying to bleed out. And so the U.S. is in second, or I guess top of the bad heap. But China, despite all the rhetoric and the Cold War 2.0 stuff, got a strong currency. have stronger growth by orders of magnitude stronger. Now, yes, they have problems with energy shortages and high oil prices, but I don't know. So that's a long explanation of DXY.
No, it's a good explanation, and I did tweet this out, and someone said, I mean, because yields did spike as well, so that has the effect of dragging foreign investment into the dollar as well. One other thing I don't know if you saw this, but Russell Clark actually shut down his fund, and Jim Bianco had this great tweet about it, which is, I'm not saying that this is near a top, but these are the type of things that actually happen at the top. And Russell Clark is just an extremely thoughtful guy and a great money manager. So, take that.
Well, Michael, I'll give you a second one for that, right? And I would say if I hear something once, I remember it. If I hear it twice, I write it down. If I hear it 3 times, I do something about it. So Russell Clark, one of the great short sellers of all time. I mean, he's not Mark Cohodes, but he's definitely one of the great short sellers of all time. So shutting down. 2 was talking to a very good friend who had, past tense, a very large and very successful hedge fund over a 20-year period. And he has shut down and converted to a family office. And I was talking to him the other day, and he said, look, it just got to the point where shorting was impossible. Mm-hmm. Right? In an age of algos and HFTs, it just became impossible. And the ability to gain an edge there and hold your positions vanished. So I said, I'd much rather focus on where the opportunity is, which is what Tiger Global has done, right? Turned into a private equity firm. What Co2 has done, turned into private equity or venture capital, growth equity. I said, that's what I'm doing with my family office. I'm doing late stage private. I'm doing, a few tech stocks long, and that's where we are. And look, we printed $4 trillion. I always pause for effect when I say the word trillion, because a trillion is $1 every second for 31,710 years. So 4 of those babies. And the crazy stat is all of it ended up in 4 stocks. Google went up by $1 trillion. Apple went up by $1.5 trillion. Facebook went up by close to $1 trillion, and Amazon went up by $1 trillion. So maybe Microsoft, maybe it's 5 stocks. And there's no chance, 0 chance that those companies, and we can throw Tesla in here too, created value equivalent to that amount, right? Not possible. There's not enough profits and just it's not there. And I've said all the time, right? I mean, Tesla doesn't make money. So at some point you have to return money to shareholders like Amazon eventually did. But, for years they didn't make money either, but at least they were generating cash flow. Tesla doesn't generate cash flow. They have to borrow money from the markets and then incinerate it. They're a cash incineration engine. But I don't know. I do worry that we've entered a world, we talked about the dog coins. Who would buy an asset just because other people are buying that asset that has no utility? Right? There's no development activity. There's no use case. Merchants aren't going to start accepting Doge as payment. They're just not. So, that is the definition of mania, right? You want to call crypto tulips? You can point right there. Bitcoin, not tulips. Ethereum, not tulips. Solana, not tulips. Doge, tulips. Shiba Inu, tulips.
Well, this is a true. I mean, so Jason and I, so we're in London right now. We got dinner with an old friend of ours who's working as a financial advisor, and we were talking about crypto. And just like many of these conversations do, I think it's really hard to have what feels like an unemotional conversation or rational conversation. And it's hard because I've been in the space for a long time. We started Blockworks with the idea of educating people and bringing people in. It's really hard to bring in a new group of people. And what it eventually came down to for him was, well, what are you going to tell me? Anyone can just create anything. Look at Shiba Inu. Is people going to use that as payments? And you try to walk them through the fact that people, I think the biggest haters of Shiba Inu honestly come from within the crypto industry because it undermines a lot of what we're trying to do. But it just doesn't resonate. And I'll actually skip ahead to something here, which is, yeah, you can look at speculation in crypto, but it's happening in the stock market as well. So we're looking right here at single stock daily notional traded volume, and we're at an all-time high, right? So this is in the spot market for stocks right now. Obviously, if you look at what's going on with call options, this chart comes to us from Jim Bianco Research. We're again not quite at an all-time high when meme stock mania was going on back in January of this year, but we are very close. And it's actually even worse than that because this chart comes to us from CBOE and Deutsche Bank, but you're looking at the volumes of single stock options, and they've broken it out between calls and puts. And we're at an all-time high in terms of volume for both, but it's actually skewed more towards calls. So the market is going very long here. I mean, yeah, the amount of speculation has just kind of gotten out of control. And, even going back to this idea that we're at the top, in crypto, I'm also just not even really sure what else I would put my money into right now because nothing feels solid and safe. And I think that is an issue that a lot of people are wrestling with right now.
Well, look, what the last three charts are all about is money illusion and gamification of trading, right? This is not investing. This is gambling. This is degenerate gambling. This is people literally locked in their homes, literally, right? Not physically, but basically said, don't leave your house. And so you can't watch sports because there are no sports, and you can't go to Vegas because you can't go to Vegas. And so, and by the way, here's some money. Here's $1,200. And I'd be like, wait a minute, if all of us have $1,200 and we all buy something, then the price will go up. And then we can all buy some more. And look, that is an absolutely valid, as we've seen in many examples, absolutely valid strategy until it's not. And when it ends is when the liquidity dries up. And so, yes, printing, trillions and trillions, literally, 10, I think maybe 11 trillion now across all the global central banks since 2020. That has led to an expansion of all assets, all of them, including crypto. But in the stock market, it's worse, I believe, because there you don't have the growth, you don't have the development. I mean, I pick on Apple all the time, right? I mean, Apple's earnings were roughly the same. Their actual earnings, actual income was roughly the same as 2015-16 in the last year. But their earnings per share went up because they bought back stock and did the voodoo to make it look like they were growing. But they're not growing. And so why do you pay a growth stock multiple for a company that's not growing? At least an ecosystem like Solana or an ecosystem like Ethereum, where the cash flow generation is like this, or Axie Infinity, my favorite thing, right? Which the cash flow is, they passed Fortnite. I mean, that's real cash generative business that is changing the world, literally changing people's lives. But sitting in your apartment in your pajamas, gambling on meme stocks is not investing, right? It's fine. It's a game. It's literally like playing a video game. And number go up mentality is it can go until the liquidity stops. So here's the thing. 18 months ago, 91% of central banks around the world were cutting rates. Okay. Today, that number's down to 70. So close to a third of banks around the world are not only not easing, they're actually tightening. They're taking the punch bowl away. And we've seen the China credit impulse. That is just going downhill. They're right. Pulling in liquidity to try to stop the bubble. And when that liquidity ebbs, then we will see who's swimming naked. And there's a whole bunch of stuff I'm not going to be able to unsee. I don't really want to see it.
I agree with you. And I mean, this chart, this comes to us from Urian Timmerer, who's just, man, the charts this guy produces are so great. Also a guest on this week's podcast. But when you're looking at earnings and valuation together across just the historical price of the S&P from 1980 until today. So that black line that you're seeing is actually what the S&P traded at. The band is the valuations, right? All the way from a 10x PE all the way up to a 24. And when the black line is closer to the top of the band, that we're in a period of very rich valuation. And when it goes down to the bottom of the band, that's when valuation is kind of going down. You can see where we are now. We're very, very richly valued in terms of the S&P 500. And if you take a look at this slide, which is global earnings growth, Urian's takeaway from this chart is that we're kind of peaking out in terms of earnings. And if anything, it looks like there's going to be a turnover from here. So there are really two ways that you can get growth in the S&P 500. It's from earnings growth or it's from valuation. And it kind of looks like we're topping out on both.
Yeah, Michael, this is a very, very famous chart, right? In technical analysis, this is a really important chart. It's called the puking brontosaurus pattern.
Is that true?
No, I just made that up. But I made it up. I made it up actually in 2009. 2008. 2008, because we had the same pattern. And look, if you create, and this is beautiful, right? From the bottom, right? We injected cash into everything. And you created this literally vertical. I mean, companies don't grow vertically. They just don't. And earnings don't grow vertically, but it's a base effect, right? If, I think I said on one of the things the other day that I watched, the CEO of AMC, which I'm a huge fan. I think he's awesome. And he said, look, 99.99% of our revenue vanished in 1 week in March of 2000, right? We were close to bankruptcy 5 different times. So when you start from 0.01 and you go to 0.1, that's a big growth rate. If you go to 10% of your revenue, oh my gosh, look how much we're growing. And so people just can't do math. If you drew a, 25, 30 degree line through that, it's a beautiful trend, right? And that's normal, right? Stocks should go up on average about 6% real over time because they do grow and companies form and new businesses come in, but they don't go vertical. And that vertical had to end unless everybody just kept printing money. And what people have realized is there does come a point, tipping point, right? In fact, you probably see Malcolm Gladwell's book on the shelf back there. But you get to a point where you can't print more because true hyperinflation, like true loss of control, total devaluation of the currency happens. That happened in Venezuela recently. It happened in Zimbabwe, a decade ago. And that, I'm not saying we're in Weimar, but that type of vertical move is a loss of control, right? It's a loss of control of the valuation of your currency because you just created so much of it. And it's not sustainable. And, all the estimates, right, for whether it's earnings growth, whether it's GDP growth, whether it's, any type of growth for 2022 are all cratering. They're all cratering. And, it's like, I would say it's like a bouncing ball or it's like a ball bouncing down a set of stairs. Each bounce is higher, just kinetic energy. But the end of the trip is a bad place. So now that we've crested, I think the bounce down the set of stairs is going to be unpleasant.
Howdy, everyone. This episode is brought to you by Coinbase Prime, the leading prime brokerage solution for all things digital assets, providing secure custody, trading, and financing to an institutional suite of clients. On the retail side of things, I am more than happy to make this endorsement because I have been a customer of Coinbase since the day that I got into crypto. I still keep the vast majority of my assets there actually, and I do it for one reason and one reason alone, so that I can sleep easy at night knowing that my funds are safe. It's the same reason when family or friends ask me, where should I buy my first Bitcoin? I direct them to Coinbase. And now, finally, when institutions are starting to ask, what's the most safe infrastructure to use? I only point them in one direction, to Coinbase Prime. And the reason that I do that is because it is peace of mind. When it comes to security, everything is top of the line on this platform, and it's a white glove experience to boot. They've been securing client assets at scale for 8 years, which as of Q2 of this year is $180 billion. They have an industry-leading insurance policy, and they're audited by blue chip auditors so that you can sleep easy at night too. So, stop listening to me, click the link at the bottom of this episode, and go check them out for yourself. And when you get there, tell them that I sent you, because I love to get credit. When it comes to crypto, security and custody is paramount. Introducing this episode's sponsor, Ledger, your secure gateway to buy, exchange, and grow your crypto assets. I know I've got a smart audience, so I'm assuming / hoping that most of you already have your Ledger hardware wallet, but just in case you don't, this is how I think about it. I wouldn't get into a car if I couldn't wear a seatbelt, and I don't operate in crypto unless I can do it from my Ledger hardware wallet. Crypto is really exciting, but it is still the Wild West. There are lots of risks, and Ledger is the easiest way to make sure that you are still protected. And the best part about Ledger is that you don't need to make any trade-offs between security of your funds and utility of your assets, because Ledger has Ledger Live, which is a software that syncs right up to your Ledger hardware wallet, and you can do anything that you'd want to do with your crypto assets. You can easily send and receive, you can buy and exchange, and you can get access to staking. And they've actually started to aggregate some of the best DeFi apps and services out there. Two of my favorites, Paraswap, a decentralized aggregator, and they've got Lido for staking. And stay tuned, I'm going to keep you guys updated. They've got some really cool services coming out soon. Aave, Compound, and 1inch among them. So if you take one thing away from this, guys, please, please, please make sure that you're protected in this space. Get yourself a Ledger hardware wallet today and start using the Ledger Live app. Click the link at the bottom of this episode. Thank me later. And the one thing I would add here, and I actually want to return to this idea of money illusion, and especially the idea of leverage being what's needed to create bubbles. Because I haven't, there's a chart out there of FINRA margin leverage. And the last time I looked at it was about a month ago. It's at all-time highs. I'd be curious, probably look after this and see where we're at right now. But the big question here as well is how much leverage is out there and what's the political will to keep the market going higher. I think one of the big problems of the last 18 months or so is that it's kind of laid bare the way markets really work. And people are starting to say, hey, this stuff isn't really fair. So one question I actually asked Lynn and Urian earlier this week was, there's this conflicting narrative around inflation. You hear some people talk about this idea that, well, when there's inflation, actually it's kind of a shift from capital to labor, overall incomes go up and asset prices go down. It has this leveling effect. And then you also talk to some people who, have gone through inflation and say, actually, that's really a malfunction of the economy. That's not what anyone wants. And it's a bad thing overall. And usually, as is the case in any narrative, that's oversimplified. And Lynn had a really, really great explanation about how the explanation for this doesn't belong on Twitter, and it really depends on the different type of inflation. But her overall explanation for what happens when there's an inflationary period is it tends to benefit debtors and it's not good for creditors. So Morgan Housel had this great tweet of there are conflicting debt narratives going along. So actually what we're looking at this chart on the left here is household debt service payments as a percentage of disposable income. So this looks very low historically. And actually you can see that he kind of put this up against an article that came out in something like Business Insider. I don't think it was them, but it's a media outlet like them, and basically saying Americans are in more debt than ever. And, you can see from this period on the right, actually, that, it actually looks like debt holdings are at all-time lows for households. So you can see the cash balance going up, the debt going down, the value of equity going up. So that actually looks like Americans are generally in a pretty good position. This chart actually got responded to. Eugene something. Eugene, I'll give you credit in the show notes, but he actually pointed out to me that if you look at it by income, it gives you a very different demographics of income. So looking at the debt service ratios, the top 5% and the top 20% and the bottom 80%, it's a very, very different chart. So if you look at the top 5 and top 20% of earners, they're in a much, much better position in terms of their debt service ratios than, the bottom 80%, which is around, it's like 20% or something. It's very, very high. Although it does look like it's trending down. So I guess my question to you is when I look at this chart and then when I think about Lynn's explanation for who inflation benefits, if it benefits debtors, it actually kind of looks like this would be, I mean, it's good for no one, right? Everyone kind of is in a worse off financial position, but relatively, it actually looks like the bottom 80%, if they tend to be more indebted, would benefit from an inflationary. I know that's a weird thing to even say out
No,
loud.
okay. It's again really good analysis, but I think that the subtle thing that's missing is asset ownership. Right? The reason debt is good when you're wealthy is you don't have revolving debt, you don't have consumer debt, you don't have credit card debt, you have mortgage debt, you have second home debt, you have rental income debt, you have business debt, private business debt. And what you want to do, right? And look, the elite got the memo. In 1975, they got the memo. Buy up as many assets as you can and lever them like crazy. And 10 years ago in the global financial crisis, the banksters propagated that memo writ large, right? And then with the Tax Act that Congress passed during the Trump presidency, the businesses got the memo. So asset, ownership, you should lever up, right, by appreciating assets and lever the shit out of them. Okay. The problem for the bottom 80%, they don't own any assets. They don't own stocks. They're not margining their stocks. They're not putting a mortgage on their second house. They don't even have a house in many cases. They're paying rent. And so their debt is debt that is taking money off the table, literally, that would go for food, medicine, medical procedures. And they are half a paycheck. It used to be one paycheck, but they're half a paycheck away from bankruptcy. And this is why there's all the call for UBI and, give people free money. Like, again, bad plan. I mean, look, anytime governments allocate assets, it's just bad. They're horrible at allocating assets. We do not want governments to take assets from people and they're just bad at it. And so what we want is to encourage innovation and wealth creation and inclusion. Yes, we should have a social safety net. I'm all about that. But creating dependency is bad. And again, that's part of the dictator playbook. What you want is a scared, isolated, poor, weak populace that depends on you, the beneficent governors, to give them sustenance in exchange for votes. And that is every dictatorship in the history of mankind. And it is what all, crazy as it sounds, all of these Western democracies are trending towards. And it's very scary. And what's happening in the United States right now is very, very scary. Australia, off the charts. I mean, I saw this thing this morning, Michael. They issued, and I'll tweet about it later, but they issued a proclamation that vaccinated people are allowed to stand up and consume alcohol in the bar. But if you're unvaccinated, you must sit down to consume alcohol. What the hell? I mean, on what planet is there any logic to that other than to separate classes of people, the people who obey the government and the people who defy the government? Oh my God. I mean, next, are people going to watch and you just shoot all the people who are sitting down? Is that what happens?
Yeah. Again, just to give the other side of this view, I think, so I was listening to a podcast, a very popular podcast with these guys who I'd kind of describe as Web 2 pioneers. And on the one hand, I agree with this argument, right? There's this kind of line of reasoning, which is we should be, instead of what governments are doing right now, which is prohibiting progress or saying that we should tax unrealized gains of billionaires, which, by the way, I strongly disagree with. But they're saying that overall that's the wrong point of view, and I do agree with that. But what they're also saying is, the internet gave rise to this, you now have more ability to get a high income paying job. It should be leveling the playing field, et cetera. And that's where I actually really disagree with them, because you can make logical arguments all you want that the internet should be leveling the playing field. Just look at the numbers. It's not. And you can blame it on the internet. You can blame it on monetary policy, whatever it is. Everything, if you're a listener of the show, I just draw everything back to wealth inequality, because the most consistent data point throughout history is that when wealth inequality gets gigantic, revolutions happen or wealth redistributions happen, right? It's one of the two. And I'm kind of, I'm adjusting my view a little bit, and I'm saying, I think actually when the free market fails, you do need government to step in and facilitate that redistribution. What do you think about that point? Because otherwise, if it's not led by the government, how do we fix that problem?
Wealth and income inequality, I've said this over and over, right, are the absolute direct result of the plan, fomented in 1913 with the creation of the Fed, to use the devaluation of the currency. Don't call it inflation. It is a systematic devaluation of the currency to rob the wealth from the masses and siphon it up to the rich through asset ownership. That's exactly what this is. And so this idea that somehow we can fix that by the government confiscating it and redistributing it, I think is totally wrong, right? I mean, you can use the internet to get a better job, right? There are more jobs today than at any time in human history, right? Fact. And every time people worry about the jobs that are going to get nuked, like in North Carolina where I live, right? All the textile manufacturing jobs got nuked and sent to China. And I remember Trump coming down here and saying, to this woman, I'm going to get your job back. Like, no, you're not. That job's never coming back. Now, we could enroll her in community college, teach her to code Python, and then she could have a job in the new economy. Or she could go work in a service business to become a massage therapist or physical therapist, or go back and become a nurse practitioner or whatever. Lots of things you could do, because the healthcare needs are going to be massive. But there's no chance that manufacturing job is coming back. And so the progress continues. But this idea that governments will somehow collect money and distribute it equitably and fairly, there's just no record of that in history happening. Because what governments do is they enrich themselves. And you can look at the lobbying, you can look at the, our senators, right? Our senators are multimillionaires, sometimes centimillionaires. How can that be? I mean, they don't make that much money, right? Except in the other things that they get compensated, like, insider trading, which is legal for them. So it's a long rambling point, but I am absolutely of the view that, nothing creates more value than entrepreneurship, innovation, and business formation.
I'm with you.
And anything that we do to inhibit that, right? Paying people to stay at home inhibits the entrepreneurial spirit. It inhibits, right, the creative spirit. It inhibits the, wealth creation engine that is the formation of small business. And so not having enough workers at a business so that business goes out of business is bad for the masses, but who's it good for? It's really good for the people at the top, because it creates more dependence on the dictators. And this is it's a very subtle but very sinister. Now, last time was Sinister Saturday, but this is I don't know. So what I love about where I've gone now, right, into this Web3, like I went to a Web3 meetup the other night here in Chapel Hill, and it was awesome. I mean, it was just awesome. The energy, the vibrance, and what was cool about it is I thought I was going to be the oldest guy there, and I actually wasn't. And that was very cool. So it wasn't just a bunch of crypto kids. This was, and I don't mean crypto kids in a derogatory fashion. I just mean that people younger than me who I admire for their energy, their enthusiasm, their brilliance. You know, I tweeted about this last night, that the migration of talent. I mean, I was following so many people last night. My finger got tired. I was literally overwhelmed at the number of people I just wanted to go hang out with and go talk to, because they're just so brilliant and doing such amazing things. And that's what I mean by crypto kids. I mean it in a loving, inclusive, not in a derogatory mean. I'm not a kid. I feel like a kid. I act like a kid, but I'm not a kid. But it was amazing. And so and they all talked about, we want to make, the research triangle, not the old research triangle with IBM and the Defense Department, but we want it to be Web3 triangle. Actually have a hashtag Web3 triangle. And they said, we can bring people here because we have higher quality of life than the taxes in California. I'm like, yes, we actually do. So all of that, I believe, leads to the compression of this craziness. Like, part of the reason we have craziness in wealth and income inequality is because we have, fudged the rules for revenue recognition, for software as a service, for stock option compensation not being an expense. Are you joking? I mean, if money goes out to people, that is an expense. And this idea that, some people in the government are like, well, there's no cost for the infrastructure bill. Like, what do you mean there's no cost? It has zero cost. Like, no, that's just not even remotely true. So this is very Orwellian, 1984-ish kind of, bad is good and down is up. No, the reality is the best solution for society is entrepreneurship, business formation, education, all the things that we used to do really, really well, and we haven't, changed with the times. Look, I mean, just one little side thing, and then I'll let you back, is education, right? Our education system is still using 100-year-old technology, right? We set up the original education system to train people how to be factory workers, right? Stand in your square, don't, question authority, memorize these facts, don't talk to each other, sit in your chair and listen to the teacher, okay? That's not the real world today. The real world is collaboration. And the people at Synthesis School, we may have already talked about this, but Synthesis School, which is the SpaceX project, what do? They said, well, our normal school, we sit alone, we listen alone, we write alone, we study alone, we take tests alone. In the real world, we talk to each other, we collaborate, we strategize, we don't do anything alone. We need to be teaching collaboration and problem solving and crisis management and interpersonal skills and EQ. I tell a story that, I took my little guy, who's now 10, to an evaluation for preschool, which I should have known that was a bad thing. And they said, we've noticed some behaviors with Will. I'm like, oh, really? I'm like, what? He says, well, he's having a hard time sitting on his square. I'm like, I'm out. I don't want my 4-year-old sitting on a square, ever. Like, don't ever do that. And I said, well, what else? And they said, well, he was walking around the classroom, picking up things and looking at them. I said, oh my God, you mean he might have curiosity? That's somehow a bad thing in the world now? I'm so out. And if that's what people think we're supposed to do to our children, yeah, then we could be in trouble.
I'm laughing because every report card I ever had as a kid, up through high school, it was something to the effect of Michael can't sit still. I've never been able to sit still either. So my whole life.
Solidarity, brother.
Solidarity. I've gotten that feedback too. I think, we're talking about education. If I was a single issue voter, you can't be a voter on wealth inequality. If I was a single issue voter, it'd be on education. It's a huge core family value that's been drilled into me ever since I was a kid. I think it's really, really important. It's cropping up in local elections, by the way. I don't know if you paid attention to Democrat versus Republican elections. What goes into our our school system and what's being taught in public schools is becoming a big issue in the US right now. I think the cleanest version, the cleanest framework to just look at what's going on is that folks are just waking up and questioning our institutions. Whether it's someone at the top who's doing this in a very directed way, whether this is the rollover of policies that began in the 1940s and they were well intended, but they're just not working anymore. Look, as someone who's, I can't speak for my whole generation, but what I will say is when I look around at the institutions, whether it's the media or education or the government or politics, I'm increasingly feeling not super enfranchised. And I think you can look at that as a negative, or you can look at it as a positive and say, hey, we're going through a big transition here and we're in the process of building things that will ultimately look better and serve the next generation of people. And one point that I see get brought up on Twitter, Mike Novogratz tweets about this. We're going to get him in Mike DAO. I don't know if I've told you about Mike DAO, but I'm really pumping this. The DAO of just Mikes, which
I know. I'm going to have to change at first I was going to change my name to Dan because of Moorhead and Tapiero. Now I got to change my name to Mike. So I guess I'll become Dan Michael.
Mike DAO. We'll accept Mark. You'll be honorable member of Mike DAO. But he tweets about, the age of politicians in general. And you would never elect someone who's 80 years old to be the CEO of a Fortune 500 company. Why on earth would you have them leading our country? They're lovely people. But look, it's a totally different world, and we're going through a transitional point. You got to understand the perspective of the people who are going to inherit the world, and let us just make our own mistakes and try our own systems. But I think, so to your point.
Well, first of all, neuroplasticity is fact, right? Mm-hmm. It's just fact. And, we can do everything to try to stop the aging, not stop the aging process, but we can try to defend against neuroplasticity and all that stuff. And I think hanging out with young people is one way to do it. But, we've all seen the image. Biden is a 35-year-old saying, it's time to pass the torch. People, get out of the way, talking to the old people in government. And now he won't pass the freaking torch. I mean, so it's crazy, right? Pete Buttigieg should be our president right now. Full stop, right? He was the smartest candidate by far. He would do a great job. He's the most inclusive candidate by far. And the idea that he got tapped on the shoulder, said, oh, no, you don't get to debate Biden because you would destroy him. You don't get to debate Trump because you would destroy him. And so, we'll see what happens. But I think you're absolutely right, Michael, that there has to be a generational shift. And it is happening.
I think so,
but
too.
It's happening in the decentralized world. And a decentralized world can be a world built, again, I don't mean a utopia. What I mean is a progressive society where, like DAOs, right? DAOs are pure democracy. Pure, right? Not cronyism, right? Not crony capitalism, but true capitalism, true democracy, true freedom. And I think we're on the verge of, I was talking about, right? We had Web 1, which was basically parallel to the x-axis. Then we had the knee of the curve, Web 2. And now we're going parabolic. And I don't mean parabolic like, oh, crazy, let's light our hair on fire. I mean opportunity that's parabolic. Wealth creation that's parabolic. Improvements to society, which are parabolic, right? Axie infinity is good for humanity. And people are like, oh, you're just so hyperbolic. I know it's good for humanity. It is changing people's lives. Gaming is changing people's lives. Play to earn is changing people's lives. DAOs are making people's lives better. And all of this is standing on the shoulders of giants, right? This is Newtonian in the sense of it is the evolution, not revolution, but evolution. Because if we don't follow the evolutionary path, to your point, Michael, we will have the big R revolution. Because when things get so out of whack that people feel disenfranchised and don't feel they have opportunity, that's when they crack. And that's when the pitchforks come out, and that's when bad stuff happens.
Totally agree. Speaking of Web3 and the future and all that kind of stuff, one story I was going to get your opinion on is I want to start doing this thing like Metaverse Watch. Just the amount of public companies that are mentioning the word Metaverse right now is nuts.
Yep.
It's, okay, so Facebook makes the big pivot. They're Meta. Great. Yep. Okay.
Yeah.
Microsoft comes out and says, we're preparing for a Metaverse too. Okay. Yep. Do we need Excel in the Metaverse? I'm a big fan of Excel. Not sure if we need it in the Metaverse.
Nope.
Now it's Disney. I can see Disney, right? I guess it would be cool to interact with the Little Mermaid in a live setting. Cool. Now, I just saw that Dropbox is fully embracing the metaverse. I don't want to say I'm calling bullshit. I just
No, but
don't
you're
get
calling
it.
bullshit, and here's why, right? You're calling bullshit because the metaverse is not a thing, right? The metaverse is a time. It's the time when the physical and the virtual world start to collide. It's a time, not a thing. The idea of a decentralized, borderless, global community and collective could be owned by a corporation is so antithetical, oxymoronic. It's jumbo shrimp, etc.
Yeah, right.
And all you got to do is go back to the video of Bill Gates in 1994, trying to convince everyone that they need to do the Microsoft intranet. Not this internet thing. That's dangerous. That's where the bad people are and the drug dealers and the terrorists. And you got to be with us where you're safe in our little walled garden. No, dude, we don't want to be owned. We don't want to be contained in a prison. We want to be in the open air of the community in a collective where all you're leveraging not your single brain. And look, Bill Gates has a big brain. Great. We don't want to leverage just one brain. We want to leverage everyone's brain because the hive mind and collective intelligence, and if people haven't seen Rod Collins talk about collective intelligence, you should have him on your show sometime. He's a trip. But collective intelligence is what drives all of this. And it's why, I co-opted the Milky Way emoji the other day. I've officially rebranded it the Metaverse emoji. So let's have everybody use that and talk about the trust net, and we'll be good.
I agree. All right, Mark, we got to end it there, I think.
Yep.
But I appreciate the socks and the commentary.
No, it's time. Hey, the roller coaster's real. Be careful out there. Keep stacking and keep building or biddling, B-U-I-D-Ling. But look, it is frothy in some areas. Do be careful. And the way to manage a portfolio in these times is to have lots of positions in highly volatile assets that are uncorrelated, and embrace as much innovation as you possibly can.
I think those are really good closing words. Yeah, and I think be careful and just try to, when you feel the euphoria getting to your head, just know that that's a warning sign. You got to train yourself to have the opposite instincts of what your body is telling you and the dopamine is telling you. Because when you start to feel invincible and you can't believe how much the number's gone up and you're looking at your account saying, oh my God, I can't believe this number's real. It's probably not real. So I would just remember that. I'm not saying everyone sell and take risk off the table. I'm just saying everyone should be a little bit careful because it really does feel, at least to me, I'm just giving you my opinion, that we're in some sort of late stages. But I will say to end on a positive note, Solana, I was blown away with the ecosystem that you guys have built. Anatoly and Raj, oh my God, what a credit to both of you. And Multicoin, guys, when you're right, you're right. Holy shit, did they crush it. And so did
Crush.
you guys.
Crush.
All right, we'll end it there. I'll see you same time next week.
All right, thanks, man. See you next week.